Good day. Hello, friends. Hello, investors. And thank you for joining me and my guest, Bill, for another session about real estate investing. We always like to bring guests to those sessions to educate you. By the way, I want to get educated as well about different aspects of real estate investing. Today, we have a very unique topic. We're going to talk about 1031 exchanges, but we're not just going to talk about 1031 exchanges in a simple or the straightforward form of 1031 exchanges, but we're going to talk about a certain aspect of 1031 exchanges when it's mostly relevant to foreign investors. Foreign investors being people who buy US real estate, invest in US real estate, but do not live in the US, and they're actually foreigners from other countries. So this is what we're going to focus on today. I brought a good friend that we've known each other for many years, and I've consulted him regarding 1031 exchanges over the years multiple times. Someone who knows real 1031 exchanges very well, with a very unique request to not just talk about 1031 exchanges, but actually talk about the sub-segment or the sub-niche of the foreign investing. I don't want to take more of Bill's time, so I want to introduce Bill Aster, who is the 1031 exchange expert that I've been working with for a long time. And I want to let Bill step up and take the lead on the conversation regarding the 1031 exchange and the niche of the foreign investors. Bill, please go ahead, introduce yourself and take over.
Sure. Good morning or good afternoon or good evening, depending on where you are located. Again, my name is Bill Exeter. I'm the CEO of Exeter 1031 Exchange Services and Exeter Trust Company. And we are a qualified intermediary or accommodator for 1031 exchanges. And the fact that we have a trust company within our family of companies means that we are one of the few qualified intermediaries that has any kind of regulatory oversight, and that is critical. So just kind of keep that in mind. You want to make sure you work with a qualified intermediary that has regulatory oversight. And one of the things I like to do is initially point out the more important parts of a 1031 exchange. So as Danny said, we're not going to go into a lot of detail, a lot of the basics, but there are certain areas where there's a lot of confusion out there, and especially when you're talking about foreign persons investing in the U.S., it can get even more confusing. So some of the things I wanted to point out real quick is the more important parts and what really qualifies, what really matters. You get a lot of noise out there. A lot of people will tell you different things, and they're, in a lot of cases, they're opinions. They're not necessarily wrong. They're just opinions. And it may not be completely true. So the first one is what we call qualified use properties. So whatever you sell and purchase through the 1031 exchange has to meet the qualified use test or requirement. And that's probably the most confusing part out there. A lot of people get hung up on the length of time that you've held title to the property, and they will tell you, well, you don't qualify because you didn't hold it for at least 1 year, 1 year and a day, 18 months, 24 months. And we'll get the phone call and they say, well, what really matters? What qualifies? So the big takeaway here for qualified use is that two things. One, there is no holding period. There's nothing in the tax code or the regulations. There's no statutory requirement that says you have to hold the property for so many days, months, or years. But what it does say is you must have the intent to hold for rental, investment, or business use. So if you get audited, that's what you have to do. You have to prove that yes, you did intend to hold it for rental, investment, or business use. And those categories also have confusion out there. So what does that really mean? So certainly rental or leasing activity. You can rent the property or lease the property out. You're collecting rents or lease payments. That qualifies. That's held for rental income, and that does qualify. A lot of what you see on the internet will say things like you have to hold it as rental property. Well, that's not completely true. Most people do, but you can buy real estate and hold it for capital appreciation. So in a lot of cases, people buy dirt and just hold the vacant land or the dirt for capital appreciation. It doesn't produce any cash flow. But that's okay. It doesn't have to produce cash flow, contrary to what you see on the internet. It just has to be held for investment. So whether it's rental or leased out, or whether it's held for capital appreciation, it qualifies for qualified use. You could also buy real estate and use it in your business, and that also qualifies. So keep in mind, it's not the length of time, it's what was your intent, and if you get audited, what can you show? Now, the length of time helps prove intent, so kind of keep that in mind. I guess what I would say is if it's a plain vanilla transaction, you're selling rental property, you're buying rental property, you're not taking any aggressive risks or positions, 1 year should be fine. That straddles 2 tax periods. If you're going to take some risks, maybe you're going to move into the property later, or maybe you already did live in it for a period of time and move out. Maybe you want to rent it for 2 years, which straddles 3 tax periods. So that's really what it boils down to. Investors who buy the real estate to do something to it. So maybe they buy it and build it, develop it. Maybe you're a builder, developer, contractor. Maybe you buy it to refurbish and then sell. So you're a rehabber or flipper. Maybe you're a condo conversion specialist. In those cases, your intent is to buy, do something to the property, and then sell. So you're holding for sale. You're not holding for investment for 1031 exchange purposes. So that would not typically qualify because you're not holding for investment. But if you bought it, did something to the property, and held it as rental or investment or business use, then it would qualify. So it's all about intent and can you prove qualified use. Secondary, you get a lot of confusion on like-kind property. There's still a lot of curriculum out there that says, if you sell a condo, you have to buy a condo. If you sell apartments, you have to buy apartments. And that is absolutely not true. Like-kind literally means you are selling real estate, you have to reinvest in real estate. That's all it means. So anything that is considered to be real property will qualify for the like-kind requirement. It includes things you wouldn't even think of, like air rights and water rights and mineral rights and certain types of oil and gas investments. So like-kind is a very broad definition, and it really gives you a tremendous opportunity to reposition your portfolio depending on what you're really trying to accomplish. Third area we get a lot of confusion on as well is how much do you have to reinvest? So to keep it easy, let's just say you sell $1 million property. You are allowed to subtract your routine selling expenses. So your broker's commission, title, escrow, documentary, transfer tax. That's going to get you a net sale price of about $950, $960-ish. Notice we did not subtract debt. You only subtract those routine selling expenses. And that's the magic number. That's what you have to reinvest. So if you sell for $1 million, your net is probably $950, $960. And whether you buy 1 or 2 or 3 properties, the total of what you purchase has to be equal to or greater than about $950 or $960, so that you can say you've traded equal or up in value. So that's really the key there. Third area we get a lot of questions on is, or I should say, a lot of misinformation probably is, people will say that the property you sell and the property you buy have to be held in the same legal name or legal title. And that's, in a lot of cases that is true, but it's not completely true. There's disregarded entities like living trusts or single member LLCs that are disregarded, things like that. So it's not the entity per se, it has to be the exact same taxpayer. So we have to drill down and ask the question, who's the real taxpayer on both sides of the equation? The one that sold the relinquished property and the one that bought the replacement property. And as long as they're considered the same taxpayer, then you're in great shape. So that's something that, we can jump on a call, we can quickly drill down as to who the real taxpayer is and see if there's any issues there to be concerned about. And those are really the 4 areas where we see the most confusion out there, the most misinformation in terms of what really matters, what really qualifies. So hopefully that kind of helps you make better informed investment decisions as you're going through that. The other area that Danny mentioned briefly is that foreign investors can buy U.S. real estate. When they sell that U.S. real estate, it's going to likely trigger a taxable gain. And that taxable gain can be deferred through a 1031 exchange. So there's a couple of items. One is you'll read things on the internet and it will say things like foreign property does not qualify, or foreigners cannot do 1031 exchanges. they mean well, but it's not accurate. It's not completely true. So there's really two things here. You have people who do file a U.S. tax return who buy foreign property that's held for investment, and you have foreign investors who buy U.S. property also held for rental, investment, or business use. And both can potentially qualify for 1031 exchange treatment. So we're focused today on the investors, foreign investors who are not U.S. taxpayers. They don't file a U.S. tax return, although in some cases they may, but in a lot of cases they don't. They buy U.S. real estate and they're holding it as some type of rental or leased property, or they're holding it for investment, or they're holding it and using it in their trade or their business. And then they go to sell that. And when they sell that, it's going to trigger a taxable gain in most cases. That's where it gets complicated. With the foreign transaction, foreign owner, I should say, the U.S. requires certain types of withholding, and it's called FIRPTA. So if you've heard the term FIRPTA, FIRPTA means it's a foreign investor that owns real property, and there's withholding requirements. It's gotten a lot more complicated than it used to be. And so FIRPTA can really complicate, delay, and in some cases really wreak havoc with a foreign investor trying to do a 1031 exchange on U.S. property. But I'll kind of walk through what you need to look for, what to be aware of, and then kind of go from there. So first off, typically if you sell, if it's a foreign investor who's selling U.S. property, there's typically a 15% withholding requirement, and that's based on the gross sale price. So that's expensive. I mean, every $100,000, you are withholding $15,000 on that amount. And that's really designed to make sure that the U.S. collects the capital gain tax or depreciation recapture taxes, et cetera. But what it does, it takes a big chunk of your cash out of the sale proceeds. And that's what makes it very difficult to complete a 1031 exchange transaction. So there are a couple of ways to deal with that. You know, the requirements from a 1031 exchange perspective are exactly the same. So they still have to sell and buy qualified use property. They still have to sell and buy U.S. real property to meet the like-kind requirement. It does have to be U.S. property for other U.S. property. They can't sell U.S. property and exchange into foreign property. It does have to be U.S. for U.S. To meet the requirements. And they do have to reinvest in terms of trading equal or up in value. The catch is that you have to reinvest all your equity. Now, in this case, if they're withholding 15% of the gross sale price, a big chunk of the foreign investor's equity is being withheld and taken away. So the question is, how do you reinvest all of your equity when part of it is getting withheld? So there's some things to be aware of, and there are ways to deal with that. So first off is when you're looking at this, plan ahead. You have to request an ITIN number, which is like a social security number or an employer identification number, but it's a tax ID number for a foreign person. Once you obtain the ITIN number, you can actually request a certificate of exemption from the IRS, and the IRS can issue this certificate that says you're not subject to withholding. And if you can get that certificate of exemption, then the selling or closing agent, whether it be an escrow company or title company or closing attorney, will not withhold on the proceeds. And that way the qualified intermediary, which is our role, we will receive all of the proceeds from the sale, and then you've got all of your cash equity working for you, and you're able to go out and buy and reinvest in replacement property. The challenges are that it used to be something where you could apply in advance, take maybe 2 to 3 months to get the certificate of exemption, and then you're in great shape. But the IRS has changed all of that. And now they require that you, with the filing, you have to have a copy of the purchase and sale agreement of the property you're selling. That's not a problem. You already know what you're selling. But you also have to have a purchase and sale agreement for the property you're buying. Well, in a lot of cases, you don't even know what you're going to buy yet. So that's one of the issues that comes up. And the 2 to 3 month process is now more like 6 to maybe even 18 months. We've had a couple where it's taken more than that time. So in a lot of cases, you're not going to get the certificate of exemption from withholding within the deadline, before you close or before you have to reinvest through the 1031 exchange transaction. So in a lot of cases, in fact, today in most cases, the escrow or title company or closing attorney is going to have to withhold the 15%. They're not going to have a choice in order to get the transaction closed. So how do we deal with that? There's different ways to do it, and it depends on the closing or settlement agent, and it depends on their policies and procedures. So one option is, keep in mind there's no deadline for the escrow company to hold what they withhold, meaning they can withhold the 15%, and if they're willing to hold that 15% in their escrow or title account or trust account and not disperse it to the Treasury Department, and then once you receive the certificate of exemption, you can get your funds back and it goes to the qualified intermediary, then you're in great shape. A lot of companies will not hold the funds for a very long period of time. They'll have a deadline, like maybe 120 days or something like that. Some will not hold the funds at all. Once they withhold, they're going to remit to the Treasury Department. So once that 15% is paid to the Treasury Department, it's no longer available. So that's where the issues really come up. How do we deal with that? So one method that is very doable, but it depends on whether the client has cash, is to take out-of-pocket cash equal to the 15% withholding amount, put that out-of-pocket into the closing. So you deposit out-of-pocket money into escrow or into the title company's account or the closing attorney's account equal to that 15%. You are literally funding your own withholding by putting out-of-pocket cash into that. And by doing that, now the closing has all cash. The settlement agent is going to release all the cash to the qualified intermediary. You have all the cash so you can proceed with the purchase of your replacement property in the 1031 exchange transaction, and you have a successful 1031 exchange transaction. So that's the positive. That's the easiest approach to deal with. The next step, though, is where it gets a little challenging. You're probably going to have a settlement agent that is going to remit payment to the Treasury Department, and then you will probably have to file a U.S. federal tax return and calculate whether you owe taxes or not. In a lot of cases, you won't owe any taxes. And in those cases, then you have to, or you would request a refund through the filing of that tax return. That's how you would get your funds back. So that would certainly work, but it requires you to come up with that cash up front and deposit that into the closing. A lot of folks don't have cash laying around, so that may not be a very practical consideration. The worst case scenario is where you don't have the cash, the escrow, title, or closing attorney withholds the 15%, they remit it or pay it to the Treasury, and your transaction closes and you're short by that 15% withholding. And as the qualified intermediary, we're going to receive all the net proceeds except for that 15% withholding, which means that 15% withholding is not going to be reinvested in replacement property. And since it's not reinvested, it then becomes taxable, what we call taxable boot. And you pay tax on that amount because it wasn't reinvested. It won't hurt the 1031 exchange. It doesn't mean your whole 1031 falls apart. It just means that dollar amount was not reinvested. So that 15% specifically would be taxable. Everything else would be tax deferred. So that's kind of worst case scenario. Best case is you put out-of-pocket funds in to self-fund the 15% withholding. So it's kind of whichever one works best for you. There are attorneys and CPAs who specialize in FIRPTA and FIRPTA filing requirements. I would highly recommend that you immediately address that. If your CPA or attorney doesn't have a specialty there, Danny or I could refer you to somebody who does, and I would recommend that because this can get very, very complicated very, very quickly. But at the end of the day here, when the dust settles, foreign investors can buy U.S. property, they can sell U.S. property, and they qualify for 1031 exchange treatment. They can defer the payment of the taxes. They're just going to have to deal with the FIRPTA issues, and it kind of is what it is, but Danny and I or your attorney or CPA, we can all jump on a call and kind of walk through the process and see what the issues might be and see how we can help you get through the process. But that kind of gives you a very, very quick overview of the more important points of a 1031 exchange, the issues that a foreign investor are going to confront in terms of FIRPTA withholding, and how we kind of help walk you through that. And Danny, that's a quick overview, a quick whirlwind tour.
I have a question or two. So if I can, first of all, thank you for putting it so clearly. In my opinion, a lot of people, when it comes to tax or tax planning or tax engineering or tax navigation, they get bored. I get excited, right? Because I think this, we try to make so much money investing, but we are never putting the same energy into saving, so to speak. So first of all, the most important thing that I think is the biggest misconception about this niche: if you're a foreigner, you can still benefit from a 1031 exchange, right? This is like for me, the highlight, right? Which is, we can stop over here because I think that's a big misconception. Mm-hmm. Now, you mentioned about the challenge is the 15% withholding tax, and you presented a few ways. It sounds like, if I heard correctly, if I'm trying to do an exemption, it's going to be more challenging these days because the IRS is looking for both sale agreement and purchase agreement. So only if I'm able to juggling, and it is possible, but very, 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 very challenging. If I'm able to present both, I may be able to get the exemption.
Yep, absolutely right.
Okay, so there is a possibility. Does that mean that the chances of me getting an exemption without the purchase agreement on the next property, does that mean that no chance I'm going to get it, or chances are lower?
It means you won't get a certificate of exemption unless you absolutely do have the purchase contract for the new property. That was one of the changes that they made. If the seller of the property is willing to cooperate, and the buyer of your property is willing to cooperate and give you enough time to file and get that certificate of exemption, that would be fantastic.
Yes, of course. That's why it's a very, very challenging, but not 100% impossible. Yep. I agree with you on that.
Absolutely.
The second thing is, few years ago, or maybe many years ago, there used to be an exemption on withholding. This has nothing to do with obviously the exchange. If you sell a residential property below $300,000, then I don't know if it's an automatic exemption, if it's a discretion of the escrow or title, or you have to ask for an exemption as well. Do you know anything about a certain threshold of price point that may be exempt in any event?
Yeah, there is certain exemptions. They did change those, and I believe they actually lowered the exemption in some cases. It was $300,000, and now they've changed that. And I don't know exactly what they are today, but there are some exemptions available. I believe it's if it's their primary residence and the sale price is under a certain dollar amount. So if it's rental, investment, or business use property, I don't think any of the exemptions apply, but it's only if it's their primary residence.
I see. Okay, so it's only on primary, not investment property. Very likely, we maybe want to check that. What is the threshold? And also, what I've remembered from the past is that as long as it's being sold to a non-foreigner as well.
Correct.
Yeah. Okay.
Yep. And there are some exemptions that if the foreign investor, for example, buys their rental or investment property through a U.S. corporation or a U.S. partnership, then they're probably exempt from the withholding because it really is a U.S. entity. That is the taxpayer. But if they're selling as an individual, that's where it becomes a little challenging.
Okay, so I wanna. That's an excellent point, and I wanna emphasize that to make sure at least I understand. I'm a foreigner. I have a property that I hold directly to my name, Danny. I'm the owner, on record, on title. And if I go through I want to go through the sale and the exchange, I am probably going to be subject, to the withholding. Mm-hmm. But if I am Danny and I'm holding the property through an entity, LLC. That entity is a U.S. entity. It's not a foreign entity, although it sounds like it is, but it's not because it's a U.S. entity. That will not be subject to the withholding.
Correct. Yep. And we'd have to make sure that the entity is not disregarded. So, for example, you mentioned LLCs, which is a good example. So if LLCs, if it's a single member LLC and a disregarded entity, it's treated as if the individual's the real owner, then it wouldn't be exempt. But if it's an LLC with multiple members and it's treated as a partnership for tax purposes, it would be exempt.
Okay. So So still, if I am a single member LLC, I may or may not be exempt, or if I'm a single member, I should assume I will not have an exemption.
Correct. Exactly.
Okay. Do you know if there's a rule of thumb of how much partnership I need to have? Like, if I go to my client and I say, listen, you need to put me as a 1% partner in your LLC, so it's no longer a single member, which is an insignificant membership or risk for him, that will resolve it, or it has to be a significant partnership level?
No, I think that would do it, because a 1% interest would mean there's two partners now. It would be treated as a partnership, so that would certainly be fine.
Okay.
That would also mean that they would obtain a U.S. An EIN, an employer identification number, and they would file a U.S. tax return. So that would allow them to be exempt.
Okay. So obviously, I'm working under the assumption that my clients, at least for the foreigners, they either have the ITIN or the EIN, and typically both if they're using both mechanism in order to report properly their taxes, regardless of selling, of course. So that's normally the case. I don't have any additional questions. I really do appreciate your clarifications on those things. I'm gonna see if there's anyone who wants to ask questions, so we can open it up, and if we do, great, and if not, I think we can call it a wrap for today. But let's give someone else an opportunity to ask a question. Terrific. Bill, I really appreciated you summarizing it so well and to the point, and not keeping it at a high level, but yet very informative. Thank you for sharing this information and to taking some of my questions, and for the time. I really appreciate it.
My pleasure. Anytime. Happy to help.
Terrific. Thank you, Bill, for the information. Thank you, everyone, for listening. For those of you who are foreigners, you are most welcome to reach out either to me. I can help you a little bit with the 1031 exchange nuances, but I always refer people, when they dive into the fine details, to people like Bill, so Bill can provide you with more accurate answers. There's always challenges to doing those exchanges. I can tell you that I've done personally helped many clients do big and small exchanges. Actually, I have my lender that I work with called me last week and said, Danny, someone broke your record. I said, what do you mean? He says, you held the biggest record of doing selling one property, buying 12 other properties in 3 states using 3 different agents. And he said, that has been my record as a lender for an exchange. I have someone who just did 13 properties. So you are no longer at number 1.
You're going to have to work harder now.
Damn, I know. Yeah, we do a lot of, not a lot, but we do exchanges every once in a while. Terrific. Bill, thank you very much for your time. Thank you everyone for tuning in, for listening in, for joining. Happy holidays, and we'll see you in 2026. Bye-bye.
Good. Take care.